4 factors to consider when finding your own Forex trading niche. Ever heard of the line, try and try until you succeed? Well, I'm gonna let you in on a little secret. Sometimes, it doesn't apply to trading. One common mistake that newbie traders make is overtrading. Because of their fear of missing opportunities to make money, they throw themselves at every little setup they see. Don't get me wrong, I believe that you also have to be a risk taker in order to be a successful trader. However, there's a big difference between making well thought out trade decisions and proper risk management versus reactively risking your money blindly at every little setup that comes your way. This shotgun approach not only damages your account but also takes a toll on your psychological well-being. A typical scenario may go something like this. After losing a trade, you see a new setup and you decide to take it, thinking that it will be a winner and it will offset your loss. Shabam. The market reverses and the trade turns out to be a loser. Now you just bruised your ego and your account even more. Instead of spreading yourself out too thinly, why don't you try specializing first? This is what niche trading is all about. Royce Gracie, dubbed one of the best mixed martial artists of all time, used his mastery of jiu-jitsu to defeat fighters of mixed disciplines. It's all about finding out what you're good at, what your niche is. To define your niche in trading, you must consider at least 4 factors. By identifying them, you'll have better chances at matching the trades you take with your trading personality. Currency pairs. Each pair has its own behavioral tendencies and it's important that you match your personality with the behaviors of the pairs you plan to trade. For instance, if you enjoy trading with risk sentiment and if you like volatility, then maybe you'll do well trading crosses like your JPY and GBP, JPY. Time frames. How much time can you devote to trading? Which trading session is active during your trading hours? Do you thrive in fast-paced environments? Are you capable of making decisions on the fly or do you need a lot of time and preparation before you commit to a trade? These are questions that must be answered for you to determine your ideal time frame and define your specialty. Trading framework. There are successful traders who from many years of experience make decisions based solely on intuition and gut. So, unless you've done and seen it all, making snap trading decisions may not end well for your account. You need to develop a framework that makes sense to you to help you understand and internalize market behavior. And with this framework, whether it be chart patterns, moving averages, or trend lines, you can then make better trading decisions. Trading strategies. This basically addresses the manner in which you will be trading your market framework once you have figured out which behavioral tendencies make the most sense to you. For example, if you're good at recognizing consolidation patterns, then you'll have to figure out whether playing breakout setups or range reversals would be most comfortable for you. Some of you may be more comfortable trading ranging markets while others prefer riding trends. There are even traders that prefer working with numbers and statistics rather than charts and candlestick patterns. Keep in mind that the goal isn't to close doors and limit ourselves when undertaking niche trading. On the contrary, we do it to grow as traders. It helps us overcome the pitfalls of overtrading and sets the stage for expanding our horizons down the line. So you see, the sky's the limit once you've defined your niche, your very own corner of the sky. Be a trader, not a gambler. Why do you trade Forex? Because you want to make a ton of money and be able to buy anything you wish. While this is a perfectly valid reason, it will most likely lead to excessive greed and ultimately lead to your trading account's destruction. You might as well take your money to Vegas and gamble it away instead. Greed is the worst motivation for trading. The market will always punish greed and will reward moderation. There is a fine line between traders and gamblers. When there is real money on the line, there are always those who take blind chances. If you want to be consistently profitable, do not think like a gambler, do not take blind chances, and do not solely rely on luck. Remember that luck comes and goes just like the gambler. As a trader, you must realize that anything can happen in the markets. Until you accept this fact, you will never become consistently profitable. I know, the idea just sounds silly. How can you, as a trader, become consistently profitable in a market that has uncertain outcomes? It's just not possible. Wrong. In trading and in life, we have what is called probabilities. Casinos are profitable year after year after year, despite having a business where the outcome of each card laid down, dice roll or slot pull is unknown each and every time. They understand the concept of probabilities and create games that put the odds in their favor, in other words, the house advantage. While it is true that there will be some lucky ones that will win and walk away with millions of dollars, casinos know that if they get a large enough sample size, there will be more losing patrons than winners in the end. Let's take Baccarat, a popular card game for high rollers, for example. The game is fairly simple. Cards are dealt to a banker and a player, and all you have to do is place a bet on either one. Since you have equal access to both the banker and the player, you can even bet on a tie if you want. It would seem like you essentially have a 50% chance of winning. But in reality, that's not the case. By tweaking the rules, like charging a very small commission or reducing the payout if the banker wins with a certain number, the odds are turned slightly in favor of the house. It might be a very tiny advantage, anywhere from 1% to 5%, but it's enough for the house to eventually come out on top when enough games are played. You have to remember that what differentiates trading from gambling is being able to bend the odds in your favor. That is why, as a trader, your mind one event or trade at a time. To become consistently profitable, you have to trade like the house and play the advantage over a series of outcomes. How can you do this, you ask? Here are a few tips. 1. Study the markets. First, you need to learn the market behaviors, patterns, and tendencies that could be recognized in the future and turned into trading opportunities. This comes from reviewing price action against a framework, support and resistance, mechanical indicators, economic events, etc., recording your observations, and then devising statistics or setups. 2. Journal your trades. This is also where keeping a trade journal becomes a necessity. Using the data from your journal, you can focus on the setups that have had higher probabilities of winning rather than those setups that tend to lose. 3. Develop good risk management practices. You'll also need solid risk management. You can tilt the odds of long-term success in your favor even more if you limit yourself to setting up or taking trades that have an attractive risk management ratio, i.e., average bigger wins than losses. The better the reward to risk ratio, the less often you need to win a trade. For instance, if you notice that you are good at spotting double top formations and trading them, then you can devise a trading system that focuses on finding setups based on double top chart patterns. If you are able to take a large enough number of these trades and your winners are larger than your losers, then you'll eventually end up profitable over the long run. 4. Explore other traders' biases. Last but not least, you can look at other traders in addition to your own analysis. The internet is loaded with free economic and technical analysis content. By getting a second opinion, you make sure that you don't fall into the confirmation bias trap. Of course, these aren't the only ways to tilt the odds in your favor, but you should always remember that you don't have to predict exactly where the market will go. You just have to figure out where price will likely go and make the best of it if the trade goes your way.